When people ask whether they should pay off their mortgage early or invest the money, instead, they usually think they are asking a simple financial question. They are not. They are asking a question about trade-offs. They are asking about certainty versus probability. They are asking about control versus optionality. They are asking about whether the same dollar is more valuable when it reduces a liability or when it is put into an asset that can compound over time. That is why this question creates so much emotion. People do not argue about it as if they are comparing two clean numbers on a spreadsheet. They argue about it as if they are defending the way they survived. One person says the mortgage must be destroyed because debt makes them feel unsafe. Another says the mortgage is cheap money and paying it off early is a mistake because the market has historically produced more. Both can be right, both can be wrong. It depends on the system around the decision, in my way of looking at money. Almost every important decision has to be understood through cause and effect. A mortgage is not just a payment. It is a fixed claim against your future cash flow. An investment portfolio is not just an account balance. It is a collection of uncertain future outcomes. Inflation is not just a number reported by the government. It is the force that changes the real weight of your promises over time. Taxes are not just paperwork. They determine how much of a return you actually keep. Retirement is not just an age. It is a phase where mistakes become harder to repair. When you combine those forces, the answer becomes much clearer. At the simplest level, paying off a mortgage early gives you a guaranteed return equal to the interest rate on that mortgage. If your mortgage rate is 6%, every dollar used to reduce that loan is, in practical terms, earning a 6% guaranteed return because it eliminates a 6% cost. Investing the same dollar is different. Historically, broad stock markets have produced higher long-term returns than most mortgage rates, but those returns do not arrive smoothly. They arrive through cycles. Some years are excellent. Some years are painful. Some decades make people feel like geniuses. Some periods test whether they really understood risk before they put their money to work. So the real question is not simply, can the market beat my mortgage rate? The better question is this. After taxes, after volatility, after inflation, after my time horizon, and after my own behavior under stress, is investing likely to improve my life more than reducing this fixed liability? That is the right frame. When I study the decision, I see three broad areas. The first area is where keeping the mortgage usually makes sense. This is when the mortgage rate is very low, generally somewhere around 0 to 4%. If you have a mortgage at 2, 3, or even 4%, the math leans strongly toward keeping that debt and investing excess capital elsewhere, assuming your financial foundation is strong. The reason is simple. Over long periods, diversified stock portfolios have historically produced returns higher than that. Even a more conservative portfolio has often produced returns in the 5 to 7% range. If you are borrowing at 3% and you have a long time horizon, giving up the chance to compound at higher rates can be a large opportunity cost. But there is another force working quietly in your favor with a low fixed mortgage, and that force is inflation. Inflation hurts people who hold cash and fixed income streams that do not adjust. But it helps people who owe fixed-rate debt because the debt is repaid in dollars that become less valuable over time. If your mortgage payment is fixed for 30 years and your income rises over time, even imperfectly, the mortgage becomes lighter relative to your income. A 3% mortgage in a world where inflation averages 2 to 3% has a very low real cost. The payment may feel large in the early years, but the system is structured so that the payment gets easier with time. If your income and assets grow, the terms of the debt are fixed. The value of money is not. That is why a very low fixed-rate mortgage can be a useful asset in the right environment. It gives you long-term control over housing costs while allowing your capital to work elsewhere. If you pay it off too aggressively, you may be giving up liquidity and compounding in exchange for reducing a liability that was not very dangerous to begin with. The second area is the gray area. This is where the mortgage rate is roughly in the 4 to 6% range. This is where the debate becomes real because the numbers are close enough that no simple rule can handle every situation. When the mortgage rate is 5 or 5.5%, you are comparing a guaranteed cost reduction with an investment return that might be higher, but is not guaranteed. If your after-tax return on investments is 5.5 or 6%, the spread is not large. And when the spread is not large, risk matters more. This is where many people make the mistake of comparing a guaranteed mortgage rate to a headline market return. They say the stock market returns 7 to 10%, so investing wins. But that is incomplete because most people do not keep the full return in taxable accounts. They may pay taxes on dividends, they may pay taxes on capital gains, they may have state taxes, they may have behavioral mistakes, they may sell at the wrong time because they did not have enough liquidity. The more realistic comparison is not 5.5% mortgage versus 10% market return. It is 5.5% guaranteed return from reducing debt versus perhaps 5 to 6% after-tax investment return, with volatility attached. That is a very different equation. This middle zone is where personal circumstances become decisive. A 35-year-old with stable income, a strong emergency fund, and decades before retirement may reasonably choose to invest more. A 55-year-old with a large mortgage, limited savings, and retirement approaching may reasonably choose to reduce the mortgage more aggressively. The same mortgage rate can mean different things depending on the phase of life. The third area is where paying off the mortgage becomes more attractive. This is usually when the rate is around 6% or higher. At that level, every dollar used to reduce the loan is eliminating a real, meaningful, guaranteed cost. A 6% guaranteed return is not the same as a 6% expected return in the market. One is certain, the other is probabilistic. One reduces fragility, the other increases potential upside, but requires the ability to live through volatility at higher mortgage rates. Paying off the mortgage is not only about maximizing returns, it is about making the system more resilient. It reduces the amount of future cash flow that must go to a lender. It reduces the required withdrawal rate in retirement. It lowers the pressure on your portfolio when markets decline. It reduces one of the biggest fixed expenses in household life. That matters a lot. People often underestimate how valuable it is to reduce fixed obligations. When everything goes well, a mortgage payment is just a line item. When income falls, markets decline, or retirement begins. That same mortgage payment can become a source of stress. A fragile financial system is one where expenses are fixed, but income and asset values are uncertain. Paying off the mortgage reduces that mismatch. But even this rule should not be applied mechanically. A young person with a 6.5% mortgage may still need to invest for the long term because time is their greatest asset. An older person with the same rate may need to prioritize stability. The number matters. But the context matters more. To make the decision correctly, I would adjust the comparison in 3 ways. The first adjustment is taxes. When people say the market returns 7% after inflation, they often forget that the return they personally keep depends on where the money is invested. If the money is invested in a taxable brokerage account, there may be taxes on dividends and capital gains. Turnover can create more tax drag. State taxes can reduce the return further. A 7% return in the market may become closer to 5 or 6% after tax for many investors. If the portfolio is built with low-cost index funds and ETFs, the tax drag may be lower because these vehicles tend to be efficient. They usually have low turnover. Many dividends or qualified taxable events can be minimized, but there can still be a drag. The account type changes the answer. If you are investing in a Roth IRA, Roth 401k, traditional IRA, or traditional 401k, the tax picture is very different. Capital gains and dividends are not taxed every year. The money can grow tax-free or tax-deferred. In that case, the comparison shifts back toward investing, especially if the mortgage rate is low or moderate and the time horizon is long. So a 3% mortgage versus a tax. Advantage investment account still strongly favors investing for many people. A 5.5% mortgage versus a taxable account becomes much closer. The spread can disappear once taxes and risk are included. The second adjustment is risk. Risk is not just whether an asset can go down. Risk is whether a decline happens at the wrong time in your life. That is why sequence of returns risk matters so much. If you experience a major market decline early in retirement while you are also withdrawing from your portfolio, the damage can be much greater than the same decline would be during your working years. During accumulation, you can wait, you can keep contributing, you can buy more at lower prices during retirement. You may be forced to sell assets to fund expenses at precisely the wrong time. If you still have a mortgage, your portfolio must support that payment no matter what the market is doing. That is why a mortgage can be harmless during your earning years and dangerous during your retirement years. The debt did not change. Your position in the cycle changed. This is a principle people should understand deeply. The same asset, liability, or strategy can be good in one environment and bad in another. The quality of a decision depends on how it interacts with the rest of the system. The third adjustment is time horizon. Time is the biggest advantage young investors have. When you are 20 or 30 years from retirement, the market has a much greater chance to work in your favor. Historically, long time periods have made broad stock ownership much more forgiving. There have been painful stretches, but over very long horizons, compounding has tended to reward patience. That means the younger person should be very careful about paying off a mortgage so aggressively that they stop investing. The early dollars you invest are the most powerful because they have the longest time to compound. A dollar invested at 35 has far more potential than a dollar invested at 55. That does not mean a 35-year-old should ignore the mortgage. It means the decision should protect compounding first. Paying down debt can be useful, but not if it destroys the chance to build long-term assets in tax-advantaged accounts. As you approach retirement, the equation changes. The value of compounding is still real, but the value of resilience rises. If you are 45, 50, or 60, your ability to recover from a market decline is more limited. Your portfolio may soon need to support your life. At that point, reducing fixed expenses can matter as much as chasing an extra percentage point of return. That is why the mortgage question is not a static question, it evolves as you evolve. There are two broad paths. One path is keeping the mortgage and investing. This path is about growth and optionality. It tends to make sense when the mortgage rate is low, when you have strong liquidity, when your income is stable, when your time horizon is long, and when you can emotionally tolerate volatility. In that situation, the mortgage is relatively cheap. It may even be getting cheaper in real terms because of inflation. You are using your capital to build assets rather than to eliminate low-cost debt. That can be a rational decision if you understand the risk, and if you do not use the extra liquidity for consumption. That last condition is important. The strategy only works if the money you do not use to pay down the mortgage is actually invested. Many people say they are keeping a low-rate mortgage because they can earn more elsewhere, but then they spend the difference. That is not an investment strategy. That is lifestyle inflation with a financial argument attached. If you keep the mortgage, the freed-up capital must be disciplined. It must go into assets. Otherwise, you end up with the debt and none of the portfolio that was supposed to justify it. The other path is paying off the mortgage. This path is about stability and control. It tends to make sense when the mortgage rate is higher, when you are nearing retirement, when your fixed expenses feel too large, when you depend on portfolio withdrawals, or when the psychological burden of debt reduces your quality of life. There is nothing irrational about wanting control. In fact, in the right phase of life, control is a very rational objective. A debt-free home reduces the amount of cash you must generate every month. It lowers the withdrawal rate needed from your portfolio. It makes the household less dependent on market conditions. It may not maximize the theoretical upside, but it can make the plan much harder to break. I have seen many people confuse maximizing with optimizing. Maximizing means trying to get the highest possible return. Optimizing means designing a system that works across a range of outcomes. Those are not the same. A financially fragile person should not always choose the mathematically highest expected return. Fragile systems break, durable systems survive and compound. This is especially important in retirement. A retired person with a mortgage may need a larger portfolio to generate the same after-tax spending power. If the mortgage is paid off, the required withdrawals may fall. A lower withdrawal rate makes the portfolio more sustainable. It reduces the chance that a bad market early in retirement creates permanent damage. That is why for someone near retirement, the question may not be whether the mortgage rate is lower than the expected market return. The better question may be, does this debt make my plan more fragile? If it does, paying it off can be the better decision, even if the spreadsheet says investing might win on average. There is also a third way, and for many people in the gray zone, it may be the most balanced approach. You can do both. You can invest part of your excess cash and use part of it to pay down the mortgage. This hybrid approach reduces regret. It keeps money compounding while also reducing the debt. It respects both math and psychology. It preserves flexibility. People often want certainty in a world that does not provide it. They ask, should I do this or that? In reality, the answer is often to balance competing priorities in proportion to the risks. If the mortgage rate is low, the split may heavily favor investing. If the rate is high, the split may favor paying down the mortgage. If you are young, the split may favor compounding. If you are nearing retirement, the split may favor reducing fixed obligations. The point is to design the mix intentionally. Let me take a simple case. Imagine a 35-year-old with a $400,000 mortgage, a 30-year fixed rate at 6.5%, and a monthly payment around $2,500. Over the life of the loan, that person may pay more than $500,000 in interest. That number is large enough to get anyone's attention. If that person makes no additional payments, the loan is paid off at age 65. That is not necessarily wrong. It preserves cash flow for investing, and at 35, the person has time. Time is the asset that matters most. Now imagine that same person pays an extra $500 per month for the first 10 years because the mortgage balance is highest in the early years. Those extra payments can have a large effect. The loan may be paid off roughly 6 to 7 years early, and total interest may fall by more than $100,000. That is real value. It is guaranteed value. It is emotionally satisfying value. But there is an opportunity cost. If that same $500 per month is invested from age 35 to 45 and earns 7%, it may grow to around $86,000 by age 45. If it is then left alone until age 65, without any additional contributions, it may grow to roughly $330,000. That is why the decision is hard. Paying the mortgage may save something like $120,000 in interest and shorten the debt period. Investing may create a larger future asset, but it is not guaranteed. It depends on market returns, it depends on behavior, it depends on time. With one choice, you reduce a fixed liability. With the other, you build a variable asset. Neither is automatically superior for the 35-year-old. I would usually lean toward investing while still making modest extra mortgage payments if the rate is in that 6% range. The reason is that at 35, compounding is too valuable to ignore. The early dollars are the most powerful dollars. Going all in on the mortgage and delaying investing for many years may sacrifice the strongest compounding window of that person's life. So a reasonable system might be to prioritize tax-advantaged investing, maintain liquidity, and then send something extra to the mortgage. Maybe most of the additional cash goes toward investments and a smaller amount goes toward debt reduction that keeps the compounding engine alive while still capturing part of the guaranteed return. Now imagine a 45-year-old with the same mortgage. The numbers are the same, but the decision is not. At 45, the retirement is closer, the portfolio is hopefully larger, the recovery window is shorter, fixed expenses begin to matter more. A market downturn at this stage can be more damaging because the person has less time to rebuild. In that case, the split may shift. Instead of putting 80% of excess cash into investments and 20% into the mortgage, maybe it becomes 60 and 40 or maybe 50 and 50. The point is not the exact ratio. The point is that the risk has changed because the time horizon has changed at 45. Ignoring a large mortgage can be dangerous if it means entering retirement with high fixed expenses. That increases withdrawal pressure, it increases sequence risk. It makes the plan more dependent on favorable markets. This is why the same financial product can be a tool for one person and a burden for another. A mortgage is not good or bad in isolation. It is good or bad relative to your rate, your income, your liquidity, your age, your tax situation, your portfolio, your retirement timeline, and your psychological tolerance for debt. If you want a broad framework, I would think about it this way. Below roughly 4%, keeping the mortgage and investing often makes more sense, especially if you are still accumulating wealth and have a long time horizon. The debt is cheap. Inflation works against the real cost. The opportunity cost of paying it off early can be large. Above roughly 6%, paying down the mortgage becomes increasingly attractive. The guaranteed return is high enough that it competes strongly with after-tax investment returns, and the risk reduction can be valuable, especially in the 40s, 50s, and retirement years. Between 4 and 6%, you are in a decision zone where personal factors matter more than simple formulas. Taxes matter, account type matters, liquidity matters, risk tolerance matters, age matters, retirement plans matter, your own behavior matters. This middle zone is where people should be most careful about ideology. The debt-free person may say all debt is bad. The market person may say investing always wins. Both are oversimplifying. In the middle, the right answer is usually a thoughtful balance. There is one more factor that cannot be captured fully in data: peace of mind. Some people sleep better when they do not owe anyone. That has value. You cannot put it cleanly into a spreadsheet, but it is real. A person who feels safer with no mortgage may make better decisions in other parts of life. They may take less emotional risk. They may stay disciplined. They may enjoy retirement more. Other people feel safer having liquidity and investments for them. A paid-off house with very little cash may feel less secure than a mortgage combined with a large portfolio. That is also rational. Liquidity gives optionality. It gives the ability to respond to shocks. It prevents one from becoming house, rich in cash, poor. The point is not to pretend emotions do not matter. The point is to make sure emotions are integrated into a sound system rather than driving the whole decision unconsciously. A paid-off mortgage is not automatically a good decision if it leaves you illiquid. Investing is not automatically a good decision if you panic and sell during a downturn. Keeping cheap debt is not automatically smart if you spend the difference. Paying off debt is not automatically conservative if it causes you to miss years of compounding in your most important accumulation period. The quality of the decision depends on whether the whole system works. So if I were sitting down with someone and helping them think through this, I would not begin by asking, what does the internet say? I would ask a series of practical questions. What is the mortgage rate? How many years remain on the loan? What is the person's age and retirement timeline? How stable is their income? How much liquidity do they have? Are they already maxing out tax-advantaged accounts? What is their tax bracket? Do they have enough emergency savings? Will paying down the mortgage reduce their ability to invest? Will investing instead increase their anxiety? Could they handle a 30% market decline without changing the plan? Will they retire before the mortgage is paid off? What withdrawal rate will they need from their portfolio? Those answers create the correct decision. Not one answer for everyone, but the right decision for the individual system. The important thing is to avoid the two extremes that hurt people. One extreme is worshiping debt payoff so much that you ignore compounding, liquidity, and tax-advantaged investment opportunities. This can feel safe, but it may quietly reduce long-term wealth. The other extreme is worshiping investment returns so much that you ignore fixed obligations, volatility, sequence risk, and the psychological reality of debt. This can look smart in a spreadsheet but fail in real life. Good decision-making lies between those extremes. I like to think in terms of balance, risk, and resilience. A good financial life is not one where every dollar is theoretically optimized. It is one where the person can survive bad periods and keep compounding through them. It is one where obligations are manageable, assets are diversified, liquidity exists, and the person can stay calm. That is why the mortgage decision matters so much. It is not just about the mortgage, it reveals how you think about money. Are you trying to maximize returns? Are you trying to reduce risk? Are you trying to buy peace? Are you trying to preserve flexibility? Are you trying to prepare for retirement? Are you reacting to fear? Are you following a principle? The best answer begins when you know which problem you are actually solving. If you have a 3% fixed mortgage, strong liquidity, a long runway, and the ability to invest consistently, I would generally not rush to pay it off. I would let inflation reduce the real burden over time and direct capital toward diversified investments, especially in tax-advantaged accounts. If you have a 7% mortgage, weak liquidity, and you are approaching retirement, I would not casually ignore that debt. I would consider reducing it because the guaranteed return and lower fixed expenses could make the whole plan more durable. If you are in the middle, I would likely use a hybrid approach, invest enough to protect compounding, pay enough extra to reduce the burden, keep enough cash to avoid being forced into bad decisions. Let the plan adjust as rates, income, and life stage change. This is how I would think about it. Not as a debate, not as a rule, as a system. Because over a long life, what matters is not winning one argument about one mortgage. What matters is building a financial system that can handle different environments. Low inflation, high inflation, good markets, bad markets, earning years, retirement years, confidence, fear, opportunity, stress. The person who only optimizes for one environment usually gets hurt when the environment changes. The person who builds a resilient system can keep moving. And that is the real lesson in the mortgage question. The best decision is the one that makes your whole financial life stronger, not just the one that looks best in a single calculation. Use the numbers, respect the risks, understand your phase of life. Then make the choice that gives you the greatest combination of growth control, flexibility, and peace. That is what good financial planning is supposed to do.